All right, hello there, everyone. I hope you are all doing well. If you follow me, you know I've been thinking we're going to be a reversal, and we're going to see a reversal, and it may have started. And here is today's chart. And now here's something I want you to understand. When markets are moving higher, levels that were resistance convert into support. And we can see that happened here. We got to this resistance back in March, then in late April and early May, what was resistance converted into support. Now, why does this happen? It's a common occurrence in markets. It happens because of seller's remorse. If you look at a chart the right way, you're looking at what does it tell you about supply and demand, and what does it tell you about psychology? Well, this is seller's remorse. This is psychology. People sold here, and they thought they made a great move when the market went lower, but then it goes higher and it gets above their selling price, and a lot of these investors regret their decision to sell. And they tell themselves, I made a mistake. I'm going to buy my shares back, but I'm only going to do so if I can get them for the same price that I sold them. So if you have enough of these remorseful sellers placing buy orders at the level that was resistance, it converts from resistance into support. And that sets the stage for the next move higher. Markets don't go in straight lines. They go in a series of trading ranges, like a staircase. So when a market's going higher, what was resistance or the top of one range becomes support or the bottom of the next range. Now, as we can see up around here at 416, there's clearly resistance. But we did a reversal, and notice how, as of at least now, I mean, we'll know more over the next day or two, this level has not turned into support. So this seller's remorse is leaving the market, and that's a characteristic of us being at a top. So the recent rally is what we call a very thin rally. It was just a bunch of the big stocks are bringing the market higher, whereas the vast majority of stocks are actually going lower. Seven stocks are responsible for 80% of the Nasdaq move higher. And when that happens, it's usually a sign that whatever rally we have is getting close to the end, because the way the benchmarks are calculated, the more market capitalization something has, the more influence it has on the benchmark. So if we're looking at the S&P 500, you have to understand that three stocks, Google, Apple, and Microsoft, are 18% approximately of this benchmark. So there's 500 stocks in the index, okay, and three of them account for 18%. So in theory, money could be flowing out of 80 of the stocks and just flowing into, say, the 10 biggest stocks, and that could move the benchmark higher. And the way these benchmarks are, I say benchmark because most firms compare their performance to the S&P 500. The way these benchmarks are designed and built, sometimes it can mask underlying weakness. And I think that's the case now. So, bottom line is this, everybody. In a bullish market, when a market's going higher, levels that were resistance turn into support. So, people sold here, they regret doing so, and they tell themselves they're going to buy their shares back. And if there's enough remorseful sellers placing buy orders, the level that was resistance turns into support. As we get to the phase of a market cycle where that stops happening, that tells us that we're towards a top. So we have resistance, and notice how it has not become support. So this could be the beginning of a pretty decent move lower. All right, so make sure you check back. Please sign up for our YouTube page here, and I will talk to you soon. Thanks, everyone.